Hi, I'm Jimmy. In this video, we're looking at my personal investment portfolio. So I've made a few changes with my portfolio recently, added some things, taken some things away, and we're actually going to go through the portfolio a little bit differently this time. This time, we're breaking it out by sector because I was curious about my exposure to individual sectors. So you'll see I group them all together as we go along, and I kind of show you the changes that I've made and what I was thinking behind some of the individual investments. With that in mind, towards the end of the video, I actually want to share some of the best investment advice I've ever received on how to manage your portfolio. And basically, the long and short of it is that not all your investments are going to be winners. But again, stick with us to the end of the video because I'll show you what I'm talking about with that. Okay, now before we jump into that, I just want to tell you real quick about an investing platform that we built that is designed to make analyzing companies, finding companies, valuing companies simpler and easier. And it varies depending on the type of company you want to analyze. So if you're looking at a bank, gives you that. If you're looking at a regular company, gives you valuation methods for that. Basically designed to make it simpler and easier. I'll leave a link in the description below for how to sign up to that. But in the meantime, this is the sector, communication services, where I have the most exposure in my overall portfolio. So basically, what we're seeing here is my largest position is Meta. My smallest position is Warner Brothers Discovery. You can tell that by the size of the boxes. But the real wild card on this particular screen with this industry in mind, or this sector in mind, is Disney. So Disney's a company that I actually have to update my research on. I updated my research on Intel before, recently did a video on that. I now need to update my research on Disney and see what I want to do with it. Right now, my return since the first day I bought this stock, I'm down about 15%. By the way, all the prices that you see within the boxes are my average entry price. I'm down about 15% from the day I first bought the stock, but I actually averaged down a bit. And with the averaging down, my return is actually down about 12% total return. I'm not too concerned about that though, because when I look at my biggest position, which is Meta, well, Meta, I'm up about 135% on a total return basis. On an annualized basis, my average return's about 40% a year. So overall, I'm fairly happy with how this sector has performed so far. But again, Disney's one of those I'm going to do a video on soon, update my research on it and see what I want to do with that one. Okay, now let's jump over to the next largest sector in my portfolio, and that is technology. So the technology sector is actually where Intel would have landed. I recently sold out of Intel, taking a bit over 30% loss on Intel stock since I bought it. That's including the dividends that I've received on that. So that's actually accounted for in my total performance. I'll share that with you at the end of the video. But the rest of the sector is doing fairly good. Microsoft is up about 75% since I bought the stock on an average. When I averaged down, it was my average return, my total return, 75%, annualized return up about 35%. Flipping over to Apple, well, Apple's doing not so bad itself, up about 62% total return, but about 23% annualized. So these companies, these in the previous sector, have really been the saviors of my portfolio because they've done quite well since I started my portfolio, and it's really boosted my returns. But again, we'll get to that towards the end of the video. Okay, now the next sector up is the industrial sector. Here I have two positions in the industrial sector. My most recent position, the newest one to my portfolio, is a small cap stock called Adcore. And you can see by the size of this one, I just sort of dipped my toe in the water when it comes to an investment here. So Adcore, I like Adcore. I like the industry. I like the handful of companies that deal with the same type of things that Adcore is in. But I might be a bit early. The industry is in fact pulling back, has been pulling back. Revenue is expected to drop over the next year. Earnings per share is expected to drop. This is like the third year in a row that's happening, which is probably why it looks like it's on sale. But within the next 1 or 2 years or so, it's expected to turn around. Now, I wasn't trying to necessarily time the bottom. So my plan is stick my toe in the water, buy a little bit here. If it continues to drop, maybe next year I'll add a little more, bring my average price down. And then hopefully in time, the returns start coming our way. But I recognize the risk of this one, hence the reason for the smaller position. Then when we jump over to Lockheed Martin, well, Lockheed Martin's done fairly well since I first bought the stock. And this is one of those that are kind of a defensive holding. And by defensive, I mean, in the event of a stock market crash or a gigantic recession, a company like Lockheed Martin should do fairly well. The key is, though, if you're looking for a defensive holding, frankly, when the market's doing well, when the stock market's up, that's the time to buy a defensive holding. These companies, Lockheed Martin has not performed nearly as well for me over the past year as it did in the first year or so, because the market's been doing well. But if things go bad, I expect this one to do quite well. So I'm more than happy to sit on this as a long-term investment. Okay, now let's jump over to the consumer cyclical sector. So this sector, again, I got two different holdings. We've got Alibaba, which I've held for a while, and we got Ulta Beauty. Alibaba is one of those that I need to update my research on. It's kind of like Disney, that it's been hanging out there. It hasn't been doing all that great. I'm down slightly in this one. This is one of those that I got to update my research and see if I'm still happy with the investment thesis as far as a long-term investment goes. Then we got Ulta Beauty, and Ulta Beauty, although it's down a little bit, this is a newer holding for me. And although it's down a little bit, I'm not overly concerned about this one. This is intended to be a long-term investment. Warren Buffett and Berkshire Hathaway recently took a piece of Ulta Beauty. So, I feel like I'm in good company there. So overall, although they're both down slightly, I'm okay with my holdings in these investments right now. Okay, now let's jump over to the financial services sector. So in this sector, I got two holdings, Citi and PayPal. Now, PayPal was my most recent addition. And when I bought this, again, I took a smaller position here. I took sort of a half position, which is for me about 3 or 4%. And I did that to try to complement Citigroup because I thought that the pair of PayPal and Citi would give me decent exposure to the financial services sector without kind of overexposing myself to PayPal itself. Because again, I think that there are some risks there. So this is kind of my way to hedge against it. Then with Citigroup, well, Citigroup I like. I'm up a bit in Citigroup right now. But Citigroup has been more of a turnaround play. They went about a decade with not a lot of growth coming out of the financial crisis. They kind of popped out of the financial crisis, then stagnated a bit. And they brought in a new management team, and they brought in, they came up with a whole plan for how they're going to continue growth from here. And with that, I was able to buy it at a bit of a discount on a price to book value perspective, which if you notice on the website, a snapshot before, price to book is the simplest way to value banks. I bought it at a bit of a discount to price to book, so the stock's up a decent amount so far. I'm up about 35% total holding period return, about 15 or 16% annualized. Okay, now let's jump into the two smallest sectors within my portfolio. Energy, which is Occidental. I recently jumped into that one. And then in the healthcare sector, I have CVS. Again, the healthcare sector, I'm in about a year, down about 30% in this one, although I'm pretty happy with CVS over the long run. They bought Aetna. I'm pretty happy with their business, although I will update my research just to make sure I stay on top of things. Occidental, I recently did a video on that one. I'm a big fan of that. Buffett also owns a decent-sized piece of Occidental, so I have no problem with these investments, at least for the long run, as far as my portfolio is concerned. So then when we zoom out and look at the entire portfolio, we can see that the portfolio is fairly semi-well diversified. I'm probably still a bit too tech heavy, but that's actually worked to my favor. So my total return over the past few years, since I started the portfolio, is I'm up a bit over 12%. It's like 12.3% on an annualized basis. So 12.3% per year on average. Now, obviously, a lot of that is because companies like Meta and Microsoft and Apple and Google, the big ones in my portfolio, have done very well. Over the same time period, the S&P 500's up a bit short of 10%. So I slightly beat out the S&P 500. I'm up about 12. They're up 10, so ever so slightly. Now, the key, the lesson that I learned when I first started working on Wall Street when it comes to managing portfolios was don't necessarily worry about trying to hit nothing but home runs. I think that one of the biggest dangers in investing these days is that far too many people are trying to ride a stock to the moon and they get freaked out if they have losses. And that's just not the way portfolios work. I mean, Warren Buffett's the best investor of all time. And surely, if we go back and look at his annualized returns year to year, there's a certain amount of losses in almost every single one of those years, if not every single one of those years. And that's just the way it works. We look at this portfolio, some of them are up, some of them are down. The good news, though, is that the ones that I have been more confident in, I've pushed extra money in. I'm a bit hesitant about a company like Adcore, so I kind of dip my toe in the water. I take a 3% position. I am far more comfortable with a company like Meta or Microsoft, and I was averaging down as often as I could, putting more and more money to work. And I think that's the key. If you're aware of your confidence in the different investments that you're considering making, you don't necessarily have to get every single stock pick right. If you get even half of them right, but the bigger positions you take a shot with, and for me, the Microsoft, Apple, Alphabet, Meta, the big companies that I invested more money in, well, if those perform well, even if all the other ones don't, your portfolio is still doing well. I have about 40 or so percent of my portfolio down right now. Now I expect that to change. These are long-term investments, and I'm still beating the S&P 500. Partially because the companies that I picked that I invested more in, well, they really outperformed. So if you're looking at your own investment portfolio and you see a handful of those stocks down a little bit, don't worry about it. Don't get freaked out. Review your own investment thesis and see if you believe in it over the long run. Warren Buffett once said something along the lines of, it's not whether or not people agree with you that make you right or wrong. It's whether your facts are right and your reasoning is right. That's the only thing that makes you right. And the key is, don't let the stock price determine whether or not you're right or wrong about the investment, because you could very well buy a stock, have it pull back immediately, and in a decade, that turns out to be the best investment you ever made. So don't get too freaked out, especially by recent buys. Just stay on top of your research. It'll all shake itself out. With that being said, you can expect videos from me on Disney. We got videos on Alibaba coming. I'm also half considering looking at this portfolio. Meta, as you can see, is a bit on the high end. This is a lofty part of the portfolio. This is a bit over $500 per share right now. It looks way overvalued, and I am on the fence about taking at least a piece of this off the table, using that cash to either maybe average down with a position that I really like, or maybe find a new company to help diversify this portfolio even more. Let me know what companies you think could be interesting to analyze, and thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. And if you want to sign up to get access to the Investors Grow website that I mentioned earlier, link in the description below. Thanks a lot. I'll see you in the next video.